Something is happening right now to homeowners across America that the real estate industry does not want you to understand. Not because it is a secret. The data is public. The filings are recorded. The numbers are published by the federal government every single quarter. But nobody is connecting the dots for you. Nobody is showing you the full picture. Because the full picture is terrifying. And the people who profit from selling you a mortgage, insuring your home, and collecting your property taxes have zero incentive to explain what that picture means for your family this summer. Here is what happened. In the fourth quarter of 2025, the Mortgage Bankers Association reported that the delinquency rate for mortgage loans on residential properties increased to 4.26% of all loans outstanding. That number was up 27 basis points from the previous quarter and 28 basis points from 1 year ago. But that is the blended number. That is every mortgage type averaged together into a single figure that hides the catastrophe unfolding underneath. When you separate the data by loan type, the picture changes completely. FHA loans, the mortgages that first-time buyers and lower-income families rely on to purchase their homes, hit a delinquency rate of 11.52%. Let me say that number again because it requires repetition. 11.52%, the highest level since the second quarter of 2021. Nearly 1 in 8 FHA borrowers in America is behind on their mortgage payment right now, and the later stage delinquencies, the ones 90 days or more past due, jumped 76 basis points in a single quarter. That is not a gradual deterioration. That is an acceleration. That is the speed at which a delinquency problem becomes a foreclosure crisis. The New York Federal Reserve's fourth quarter 2025 household debt and credit report confirmed the trajectory. The share of mortgage debt 90 or more days delinquent increased to 1.38%, up from 1.09% a year earlier. That is a 27% increase in serious mortgage delinquency in 12 months. And here is the detail that nobody in the mainstream real estate media is explaining. When you break that number down by income, the lowest income quartile of mortgaged homeowners has seen their 90-plus day delinquency rate surge to 3%. That is more than 4 times higher than the 0.7% rate among the highest income quartile. The crisis is not evenly distributed. It is concentrated entirely among the people who can least afford it. The people who bought homes with the smallest down payments, the thinnest financial margins, and the most vulnerability to any economic disruption. And a massive economic disruption just arrived. Now let me connect this to what is happening on the ground. Because delinquency is the leading indicator. Foreclosure is the consequence. And the consequence has been accelerating for 12 consecutive months. Adam, which tracks foreclosure filings, across more than 3,000 counties covering 99% of the U.S. population, reported that in January 2026, there were 40,534 properties with foreclosure filings. Foreclosure starts were up 26% from a year ago. Completed foreclosures, where the bank actually repossesses the property, increased nearly 59% year over year. In February 2026, the trend continued. 38,840 properties received foreclosure filings. Foreclosure starts rose 14% year over year. Completed foreclosures increased 35% from a year ago. That was the 12th consecutive month of year-over-year increases, 12 straight months. An entire year of escalation with no reversal, no plateau, no sign of slowing down. And in 2025 as a whole, 367,460 properties received foreclosure filings, up 14% from 2024 and up 3% from 2023. 227,360 consumers experienced a new foreclosure in 2025, a 30.6% increase from 174,100 in 2024. But here is where the story becomes genuinely alarming, because everything I just described happened before the economic conditions of 2026 hit the housing market. The data I just cited covers through February 2026. The U.S.-Iran war that began on February 28th had not yet produced its full impact on oil prices, consumer spending, employment, or housing affordability when those numbers were recorded. The jobs market had not yet reported the loss of 133,000 positions in February. The oil shock that pushed crude above $119 per barrel had not yet worked its way through gasoline prices, grocery costs, and household budgets. The insurance premium increases that were already crushing homeowners had not yet been compounded by the inflationary effects of a war in the Middle East. Everything that is about to hit the housing market this summer is landing on top of a foreclosure trend that was already accelerating before any of it happened. Let me explain the mechanism that turns a delinquency into a foreclosure into a lost home, because most people do not understand how the 90-day clock works. And understanding that clock is the difference between keeping your house and losing it. When you miss your first mortgage payment, your servicer sends you a notice. You are 30 days delinquent. At this stage, most people catch up. They had a bad month, they got paid late, they forgot. They make the payment and the account resets. When you miss your second payment, you're 60 days delinquent. Your servicer calls you. Letters arrive. The tone shifts from reminder to warning. At 60 days, a significant number of homeowners are already in financial distress. They did not forget to pay. They cannot pay. But they still have options. They can request a forbearance. They can apply for a loan modification. They can sell the home while they still have equity. At 90 days, the architecture of foreclosure activates. Your servicer is now legally required in most states to begin certain procedures. A notice of default or a lis pendens is filed. The clock on your right to cure begins, depending on the state you live in. You may have as few as 20 days or as many as 120 days to bring the loan current before the property is scheduled for auction. This is the 90-day window. And right now, as of the most recent data available, there are more than 850,000 borrowers in the United States who are either 90-plus days past due or in active foreclosure. That number is up 104,000 from the same time last year. It is the largest such volume since July of 2022. Those are not statistics. Those are families. Those are people who went to work, made their payments, believed they were building something permanent, and are now 90 days from losing everything. But what pushed them to this point? Because mortgage delinquency does not happen in a vacuum. People do not randomly stop paying their most important bill. Something forces them off the edge, and in 2026, there are 4 forces pushing simultaneously. Each one alone would be concerning. Together, they create a compound pressure that the housing market has not experienced since 2008. The first force is insurance. A study published on March 24, 2026 by economists at NYU, Rice University, and the Federal Reserve Bank of Dallas analyzed data from over 6.7 million borrowers and found that homeowners' insurance premiums rose approximately 70% between 2019 and 2025. 70%, nearly 3 times faster than general inflation. The average annual homeowner's insurance premium reached $2,948 at the end of 2025 and is projected to climb another 4% in 2026 to approximately $3,057. But in high-risk states like California, Florida, Texas, and Georgia, the increases are far steeper. Some Florida homeowners have seen their premiums jump from $2,400 to over $4,000 in a single year, a 71% increase on a single line item in their monthly budget. And here is the mechanism that nobody explains. Most homeowners do not write a check for insurance separately. Their premium is collected through their mortgage escrow account as part of their monthly payment. When the insurance premium increases, their monthly mortgage payment increases automatically. The homeowner with a fixed-rate mortgage who believed their payment would never change opens a letter from their servicer and discovers their monthly payment has risen by $100, $200, sometimes $300 or more. A survey by Loretta found that 39% of borrowers with fixed-rate mortgages mistakenly believe their payment cannot change. They do not understand escrow. They do not understand that their fixed interest rate does not fix their total payment, and when the increase hits, they are unprepared. The Dallas Fed research found that for every 1% increase in insurance costs, foreclosure rates rise by approximately 1%. First Street, a climate risk research firm, projected that foreclosures across the United States could increase by 380% over the next 10 years due to flooding, wind, fire, and other climate-related events driving insurance costs higher. By 2035, these events could be responsible for up to 30% of all foreclosures nationally. The second force is property taxes. Counties across America delayed property reassessments during the pandemic. They are catching up now. Home values that appreciated 30, 40, 50% between 2020 and 2023 are being reassessed at current market values. Tax bills are surging. A Loretta survey found that 62% of borrowers cited rising property taxes as the primary driver of their increased monthly payment. When your home was assessed at $285,000 and your county reassesses it at $342,000, your annual tax bill can jump by over $1,000. That is an additional $80 to $100 per month added to your escrow, on top of the insurance increase, on top of the principal and interest you were already paying. For a household living paycheck to paycheck, which describes the majority of American households in 2026, that combined increase is the difference between making the payment and missing it. The third force is the labor market. The economy lost 133,000 jobs in February 2026. That number was revised from the initially reported loss of 92,000, meaning the labor market was 44% worse than originally disclosed. While March showed a rebound of 178,000 jobs, The underlying details revealed declining work hours, slowing wage growth at 3.5%, annually, the lowest since 2021, and rising long-term unemployment. 1.8 million Americans have been out of work for 27 weeks or more. Discouraged workers surged by 144,000 in a single month. The broader U6 unemployment rate edged up to 8%. When you lose your job or your hours get cut, the mortgage payment is the largest fixed obligation you face. It is also the one with the most severe consequences for failure. Miss your credit card payment and your score drops. Miss your car payment and the car gets repossessed. Miss your mortgage payment and you lose the roof over your family's head. The fourth force is the one that arrived 5 weeks ago and changed everything. Oil above $100 per barrel. The Iran war that disrupted the Strait of Hormuz and sent energy prices surging acts as a direct tax on every household in America. When gasoline goes from $2.80 to $3.50 per gallon, a family driving 2 vehicles spends $1,200 to $1,800 more per year on fuel alone. When diesel hits $4.16, grocery prices rise because every link in the food supply chain runs on diesel. When utility costs spike because natural gas markets are disrupted, the monthly budget that was already stretched by insurance increases and tax reassessments and stagnant wages snaps. The homeowner who was $100 short every month is now $300 short. The homeowner who was making minimum payments on credit cards to cover the escrow increase can no longer make the minimum payment either. And the spiral begins: 1 missed mortgage payment, then 2, then 90 days, then a notice of default. Then a scheduled auction. Then a family standing on the sidewalk watching their home sold to the highest bidder on the courthouse steps. And the FHA borrowers are at the center of this storm, nearly 12% delinquent. These are the first-time buyers who purchased homes in 2022 and 2023 when mortgage rates spiked and affordability was already stretched to its limit. The MBA data shows that those vintage years are performing significantly worse than loans originated in 2020 and 2021. The FHA's own data shows a 60% redefault rate on loans that received pandemic-era modifications. 60% of borrowers who received help went back into default. The pandemic relief programs that kept millions of homeowners in their properties have expired. The Veterans Affairs Servicing Purchase Program ended in May of 2025. The VA foreclosure inventory has surged to its highest level since 2019. The safety nets are gone, and the economic headwinds are intensifying. Now, let me address what you're going to hear from the real estate industry, because they will tell you 3 things, and all 3 of them require context that they will not voluntarily provide. They will tell you that foreclosure levels are still below pre-pandemic norms. That is technically true. Foreclosure filings in 2025 were down 25% from 2019. But that comparison is misleading because 2020 through 2023 were artificially suppressed by government moratoriums, forbearance programs, and stimulus payments. The current trajectory is not stable. It is accelerating. 12 consecutive months of year-over-year increases. Foreclosure starts up 26%. Completions up 59%. The direction matters more than the absolute level. A river that is rising 26% per year will eventually flood, even if it has not reached the high water mark yet. They will tell you that homeowner equity is at record highs, and that is true for the average homeowner, but averages conceal the distribution. The lowest income homeowners, the ones with FHA loans, the ones with the highest delinquency rates, are the ones with the least equity. Many FHA buyers put down 3.5%. In markets where home prices have declined, and prices have declined in multiple metropolitan areas, those buyers are already underwater or approaching it. Inman reported that falling home prices have left nearly 1 million Americans underwater on their mortgages. When you are underwater, you cannot sell to escape the delinquency. You cannot refinance to lower your payment. You are trapped. And the foreclosure becomes the only exit. They will tell you this is nothing like 2008. And structurally, they are correct. The lending standards today are meaningfully higher than the subprime era. There are no ninja loans. There are no adjustable rate mortgages resetting to double the payment. The core of the conventional mortgage market is sound. But 2008 is not the only model for a housing crisis. A housing crisis does not require bad lending. It requires households that cannot absorb a shock. And the combination of 70% insurance premium increases, pandemic-era relief expirations, declining real wages, surging energy costs, and a labor market that has lost jobs in 4 of the past 9 months is exactly the kind of compound shock that pushes vulnerable homeowners past the breaking point. The crisis is not coming for every homeowner. It is coming for the homeowners at the margins. The FHA borrowers, the lower income families, the households in Florida, Texas, California, Georgia, and the Gulf Coast, where insurance has become effectively unaffordable. The veterans whose foreclosure protections expired without replacement, the families who bought at peak prices with minimum down payments and are now watching their equity evaporate while their costs escalate. So what do you actually do if you are one of the millions of homeowners facing this pressure right now? Because understanding the problem is only half the equation. The other half is action. And the window for action narrows every single day you wait. First, if you are behind on your mortgage, contact your servicer immediately. Do not wait for the notice of default. The earlier you engage, the more options you have. Request a forbearance if you need temporary relief. Ask about loan modification programs. The FHA has new loss mitigation rules that took effect October 1st of 2025, but they require you to complete a trial payment plan. You cannot complete a plan you never started. Second, review your escrow statement right now. Open it, read it. Understand exactly how much of your monthly payment is going to insurance and how much is going to property taxes. If your insurance premium increased significantly, shop for a new policy immediately. The Dallas Fed research found that financially secure households are more likely to switch insurers in response to premium increases, and switching can meaningfully reduce costs. Get quotes from at least 5 carriers, raise your deductible, ask about available discounts. A $200 reduction in your annual premium translates to nearly $17 a month in your escrow payment. It is not dramatic, but when you are on the edge, $17 is the difference between current and delinquent. Third, if your property taxes were reassessed higher than you believe is accurate, protest the assessment. Every county has an appeal process. The deadline varies by state, typically 30 to 90 days after the notice. Bring comparable sales data. Bring evidence of your property's condition. Many protests result in reduced assessments and lower tax bills. Fourth, if you have equity in your home and you can see that the math no longer works, consider selling before the 90-day clock starts. A voluntary sale preserves your credit, puts cash in your hand, and gives you the ability to rent and regroup. A foreclosure destroys your credit for 7 years, may result in a deficiency judgment depending on your state, and eliminates every option except starting over from zero. Fifth, do not use credit cards to cover mortgage shortfalls. The average credit card interest rate is above 21%. Borrowing at 21% to pay a mortgage at 6 or 7% is a mathematical death spiral. If you cannot make the payment without credit card debt, the payment is no longer affordable. Acknowledge that reality before the debt compounds beyond your ability to service it. Sixth, if you are a veteran with a VA loan, contact the VA directly. The VASP program has ended, but the VA still offers other workout options. Do not wait for your servicer to inform you. Be proactive. The VA foreclosure inventory is at its highest level since 2019, and the people who act first get the most favorable terms. The numbers are clear. 4.26% overall delinquency, 11.5%, 2% FHA delinquency, 850,000 borrowers, 90 days or more past due. Foreclosure filings up 14% in 2025. Foreclosure starts up 26% in January 2026. Completed foreclosures up 59%. Insurance premiums up 70% in 6 years. Oil above $100. Wages growing at the slowest pace in 5 years. And every single one of these pressures is intensifying, not receding, as we head into summer. The real estate industry will keep telling you the market is healthy. And for the majority of homeowners with conventional loans, substantial equity, and stable employment, it is. But for the millions at the margins, the ones the national averages render invisible, the 90-day clock is already ticking. The question is not whether foreclosures will increase this summer. The documented data confirms they have been increasing for 12 consecutive months, and every underlying driver is getting worse. The question is whether the homeowners who are vulnerable to this wave understand their options before the clock runs out. Because once the notice of default is filed, the choices narrow dramatically. And once the auction is scheduled, the choices disappear entirely. Let me take you through the historical parallel that makes this summer particularly dangerous, because people keep saying this is nothing like 2008. And in terms of lending quality, they are right. But in terms of the economic mechanism that produces foreclosures, they are ignoring the part of history that matters most. In 2007, before the Great Recession officially began, mortgage delinquencies started rising among subprime borrowers. The mainstream analysis said it was contained. The data showed overall mortgage health was fine. The problem was in a narrow segment of the market. Sound familiar? FHA delinquencies at 11.52%, while conventional delinquencies sit at 2.89%. The American Default Index, which tracks the relationship between FHA and conventional delinquency rates, has documented that before the 2008 crisis, FHA delinquency rates began rising 6 to 9 quarters before conventional mortgage delinquencies followed. FHA borrowers serve as the canary in the coal mine for broader housing distress. When the most vulnerable borrowers start failing at accelerating rates, the broader market follows within 18 to 27 months. The FHA delinquency rate today is 6.5 times higher than the conventional rate. That gap is the defining feature of today's mortgage market, and most reporting blends the two together into a single figure that understates the stress among borrowers who are actually struggling while overstating risk among those who are not. The New York Fed data reinforces this pattern from a different angle. They tracked that borrowers in the lowest income areas have seen their 90 or more day delinquency rates surge from 0.5% to nearly 3% since 2021. A six-fold increase concentrated entirely among the households with the least capacity to absorb any additional financial shock. And that shock arrived in the form of the Iran war on February 28th. Here is how oil prices translate into housing foreclosures. It is not a direct line, it is a cascade. When oil goes above $100, gasoline follows within days. When gasoline rises, every American who drives to work faces an immediate reduction in disposable income. For a two-vehicle household, a $1 per gallon increase translates to roughly $1,200 to $1,800 per year in additional fuel costs. That money does not materialize from nowhere. It comes out of savings, out of discretionary spending, or out of the ability to make other fixed payments. At the same time, diesel fuel powers every truck that delivers every product to every store in America. When diesel crosses $4 per gallon, shipping costs surge. Those costs are passed through to food prices, consumer goods, and services. The Department of Agriculture data already showed food prices running 2.9% higher year over year in January, before the oil shock. By the time the full impact of sustained $100 oil flows through the supply chain this summer, food inflation will be materially higher. Now layer that on top of a homeowner who was already stretched. Their insurance premium went up $300. Their property taxes were reassessed higher by $150. Their wages grew at 3.5%, while inflation ran above the Fed's target. They were maybe $200 short every month, managing it with credit card float. Then gasoline jumped to 70 cents per gallon, and their grocery bill went up $30 per week. The credit card that was providing the float is now maxed. The minimum payment on that card just went up because the balance grew. The total monthly shortfall went from $200 to $500. And the mortgage payment, the single largest fixed expense in their life, is the one they cannot make. Multiply that scenario across the 850,000 households currently 90 days or more past due. Add the 2 million households that are 30 or more days delinquent but not yet in foreclosure. Consider that 62 million homeowners hold a mortgage in the United States, and 4.26% of them are currently delinquent. That is approximately 2.6 million households behind on their mortgage right now, before the full impact of the oil shock, the jobs losses, and the summer insurance renewal cycle hit. The insurance renewal cycle deserves its own explanation because it is the mechanism that most people do not see coming. Insurance policies typically renew annually. For millions of homeowners, renewal happens in the spring and summer months. When the new premium arrives, it is higher than last year. The escrow analysis adjusts, the monthly payment increases, and because 39% of fixed-rate mortgage holders do not understand that their payment can change through escrow, the increase arrives as a shock. The servicer sends a letter. The homeowner opens it and discovers they owe an escrow shortage from last year, and their monthly payment going forward is increasing by $100, $200, or $300. For a household already stressed by fuel costs and food prices, that letter is the trigger event. It is the moment the math stops working, and the clock begins. The geography of this crisis is not random. It follows insurance costs, property tax rates, and economic vulnerability. Delaware, Nevada, and Florida led the nation in foreclosure rates in January 2026. Indiana, South Carolina, and Florida topped the list in February. Among metropolitan areas, Trenton, New Jersey posted the highest foreclosure rate, with one filing for every 1,087 housing units. Punta Gorda, Florida, Fayetteville, North Carolina, Lakeland, Florida, and Vallejo, California followed. These are not random cities. These are communities where insurance costs have surged, where property values have begun declining in some cases, where the economic base is vulnerable to exactly the kind of compound pressure that 2026 is delivering. Florida alone accounted for the highest number of foreclosure starts in January with 3,523. Texas followed with 3,116. California with 2,790. These three states represent the front line of the insurance crisis, the energy cost surge, and the housing affordability collapse. And they are home to tens of millions of homeowners whose escrow payments are about to be reassessed in the coming weeks. Now, let me be very clear about what I am saying and what I am not saying. I'm not saying the housing market is about to collapse like it did in 2008. The structural protections are different. The lending quality is higher. The overall equity position is stronger. What I am saying is that a specific, identifiable, measurable segment of the American housing market is approaching a foreclosure wave this summer that is being driven by forces that are documented, quantified, and accelerating. And the people in that segment, the FHA borrowers, the lower income homeowners, the families in high insurance states, the veterans who lost their foreclosure protections, these people deserve to know what is coming so they can act before the 90-day clock takes their options away. If this information applies to you or someone you know, share it now, not tomorrow, not next week, now. Because the 90-day clock does not pause for anyone, and the people who keep their homes through this period will be the ones who understood the mechanism, recognized the timeline, and acted while action was still possible. Let me leave you with one final piece of context that puts this entire situation into perspective. The Federal Reserve cannot help these homeowners. The Fed is frozen. Inflation is running above its 2% target. Oil is above $100. The tariff rate is the highest since 1932. Core wholesale inflation hit 3.6%. If the Fed cuts rates to ease housing pressure, it risks accelerating inflation. If it raises rates to fight inflation, it makes every mortgage more expensive and every refinancing opportunity disappear. Jerome Powell said in late March that policy is in a good place to wait and see. Waiting and seeing is not a policy that helps a family 90 days behind on their mortgage. The government cannot help these homeowners either, not the way it did during the pandemic. In 2020, Congress authorized forbearance programs, stimulus payments, moratoriums, and direct financial assistance that kept millions of homeowners in their properties. The fiscal capacity to repeat that intervention does not exist in 2026. The national debt has exceeded $38 trillion. Interest payments on that debt crossed nearly $1 trillion in 2020. 5. The political environment in a midterm election year does not favor emergency spending programs. And the pandemic-era FHA relief options have already expired, contributing directly to the current delinquency surge. The safety net that protected homeowners through the last crisis has been dismantled, and no replacement has been built. The real estate industry cannot help these homeowners. Agents profit from transactions. They have no economic interest in preventing a foreclosure. Mortgage servicers profit from servicing performing loans. A delinquent loan costs them money in compliance, staffing, and workout administration. Insurance companies are raising premiums because their own losses from climate events are unsustainable. They are not going to voluntarily lower costs to protect homeownership. Every institutional actor in the housing system is operating according to their own economic incentives, and none of those incentives are aligned with keeping a struggling homeowner in their property. The only person who can help these homeowners is the homeowner themselves, and the only tool they have is information. Information about their rights, information about their options, information about the timeline, information about the escrow mechanism that is silently increasing their payment, information about the insurance market that is driving the increase, information about the labor market that is undermining their income, and information about the 90-day clock that converts a missed payment into a lost home. Every foreclosure in American history followed the same pattern. Financial pressure built gradually. The homeowner believed it was temporary. They used credit to bridge the gap. The credit ran out. They missed one payment, then two, then three. By the time they understood the severity of their situation, the foreclosure process had advanced past the point where the best options were available. The homeowners who survived every previous housing crisis, whether it was 2008 or the savings and loan crisis of the early 90s or the farm foreclosure epidemic of the 1980s, shared one characteristic. They acted early. They contacted their servicer before the default was filed. They explored their options while options still existed. They made difficult decisions about selling or modifying before the lender made those decisions for them. That window exists right now for millions of Americans. The data shows clearly that delinquencies are rising, foreclosure filings are accelerating, insurance costs are surging, the labor market is deteriorating, and oil prices are compressing household budgets from every direction simultaneously. If you are feeling the pressure, you are not imagining it. The numbers confirm exactly what you're experiencing. And the worst thing you can do is wait. The 90-day clock is mechanical. It does not care about your intentions. It does not care that you have always paid on time before. It does not care that the insurance increase was not your fault. It does not care that gasoline costs 70 cents more per gallon than it did 2 months ago. It counts days. 30, 60, 90, default, auction, sold, and the families who lose their homes this summer will overwhelmingly be the ones who waited too long to accept that the math had changed and that action was required before the clock ran out. You now know what the data shows. You now understand the mechanism. You now see the timeline. What you choose to do with that information in the next 30 days will determine which side of this crisis you end up on. The side that kept their home or the side that wished they had acted sooner.